conference, so please use the wireless microphone that my colleague will be handing around, and just raise your hand so she knows who wants to ask a question. We'll do one question and one follow-up, and if we have time, we can do a second round. Mark from Reuters.
Thanks very much for speaking to us today. You were saying there that you weren't overly optimistic for your forecast. Just give us a little bit more flavour of why that is. And the other interesting thing, one of the other interesting things you mentioned in your speech was about central bank independence. And over the border, we've seen another kind of prod at the independence of the Federal Reserve. I mean, how do you think that's influencing global central bank independence? Obviously, the Fed being a big name there.
So, in terms of optimistic, pessimistic, I mean, I was reacting to the question from the audience, which suggested that I may have been overly optimistic, which is, I think, the interpretation of the fellow who asked the question. To me, we have a positive outlook. We think it's that the global economy is on firm footing, and it's growing at its capacity. Its level of output is approximately at capacity. And so it's bound to moderate slightly over the next year or two. And that may be interpreted by markets as some major shift. I think that's incorrect. It's just a normal moderation to a steady state growth rate. And if, of course, the risks that people are focused on, mainly those related to trade actions that could put into question supply chains, how businesses run globally in many countries. This is a significant risk that we face, and if markets are treating it seriously, that's fine. But as I was trying to say, is that there's also another side to that risk. Of course, if those risks are realized, it'll be much worse than people are putting into their forecasts, much worse globally. And if it all gets cleared up, forecasts will be noticeably better, just as has happened when NAFTA issues got resolved. So I think that I'm trying to position us more or less in the middle, and I said numerically our forecasts are very much aligned with other forecasters, so I don't see it as optimistic or pessimistic. It's just more or less a consensus forecast. Independence, central bank independence. I'm not going to comment on specific cases, but I think it's important for us to bear in mind that central bank independence is not some theoretical concept. It is a bastion of the stability that we live in. Those of us who are old enough to remember the 1970s and early 1980s, and I see there aren't many of us here, will know what I'm talking about. So that we came out of a period where central banks did not have, rules about inflation or anything like that, and we had the great inflation of the 1970s, and it took huge increases in interest rates in the late 70s and early 80s to get us back down to a single-digit 4%, 3-4% inflation zone. Important thing about that is that if you chip away at central bank independence, you'll raise questions in the minds of investors who in fact charge borrowers a risk premium around inflation. And with a long success of keeping inflation under control, they charge very little in terms of an inflation risk premium. But if you chip away at the independence of the central bank, they'll charge more. And if even raising your bond yields by 25 basis points for a country, given the outstanding stock of debt, means a significant cost of servicing that debt that wasn't there before, and is then paid for by every citizen in the country. So we all have a stake in central bank independence. Although it sounds abstract to people, in the end it's very real arithmetic for ordinary people.
Did you have a follow-up?
Could you give us an idea of how much that risk premium could increase, perhaps?
Well, I cited the examples of Turkey and Argentina. So you can go ahead and just take a look at what that risk premium looks like today compared to, say, 2 years ago. And so, of course, in a case like Canada, where we have a long performance of inflation on 2%, that risk premium is a very small number in markets. And central bank independence guarantees that it stays that way.
From the Globe and Mail. Here in the UK, and one cannot come to the UK without getting involved in the whole Brexit debate. And I just wonder how closely you're following this, and would this play into some of the things you're talking about when you talk about trade disputes around the world, and you looked at what Canada went through with the NAFTA renegotiation. How closely do you follow Brexit, and what do you think of in terms of where Britain's going to be headed, given the pressure Canada faced over NAFTA?
Well, I'm here to prove that it is possible to come here to London and not get involved in whatsoever in the Brexit discussion or debate. But of course, as any other forecaster, we monitor the situation closely, and we're interested to understand what it may mean for the path of output for the UK in particular. And the UK is an important trading partner for Canada, so that has natural sequence, logical connection to our forecast. Not a really large one, but one that needs to be taken into account. In terms of trade disputes more generally, could perhaps just elaborate slightly. What happens when there is an outright trade war is that on both sides of the dispute, tariffs are going into place. Those tariffs mean you're raising prices for regular consumers in your economy. It causes companies then to question where they will produce. So this is where the notion that there's an underlying supply shock comes from. The economy somehow needs to restructure in relation to these new prices. And so it raises a question about whether aggregate supply in the economy will go up or down in the wake of a trade dispute, or indeed, as you've seen in the analysis of Brexit. That's exactly the sort of structural change that people need to try to understand, and it's very hard to understand in advance. But with trade, it's fairly clear that the results are you cause the economy, both economies, to slow down as that adjustment takes place, and possibly permanently so if they've made inefficiencies into the economy, hence the supply shock side, and you raise prices. And so at a time when economies are riding at more or less full employment, full capacity, raising prices raises the risk of an inflationary pulse, because you also get the exchange rate depreciating at the same time. So for two reasons, inflation picks up, and it could pick up a lot, and it's hard to imagine that being permanent, and yet it can affect expectations for a prolonged period. And so, as I've said in other contexts, that kind of scenario is one in which probably central banks are going to worry more about the inflationary consequences than they're able to cushion the blow to the real economy. So it's more likely a recipe for higher interest rates, not lower interest rates, even though it's a terrible scenario. Inflation's rising and the economy is slowing down or possibly shrinking. It's a very difficult scenario for monetary policy to really have much help in. So this is what I'm alluding to about how things could be much worse if the trade dispute continues to escalate. Talking about 2 cents or something on an aluminum can for a beer doesn't sound like much inflation, but 25% on a car, that's inflation.
Did you have a follow-up, Paul? No? Anyone else? At the back here.
Hi, Lucy Meakin from Bloomberg. I just want to ask you about your estimated range for the neutral rate.
Yes.
So around 2.5 to 3.5. And I just wondered, how sure are you that the neutral rate does fall within that range, and how much uncertainty are you factoring into it? And also, how sensitive is the range to new information?
Yeah. So, this is a concept that is a statistical concept. So it's important to bear that in mind, that when you grind it out of estimates of a macro model, there's uncertainty around all the parameters that go into it. And so there's a statistical range which could be wider than what you've just described. The range that we're offering up is more, if you like, a methodological range, that there's more than one way to calculate what the neutral rate might be. And that throws up estimates that do range from 2.5% to 3.5%. Statistically, the uncertainty is probably wider than that, but I don't have a numerical range for you. Everything in economics has a wider range around it than we realize. So, but still, it's sufficiently uncertain, and as you mentioned, it's in principle movable. That developments in the world economy could cause it to drift up or down, because there are a lot of global ingredients to that. It's not just a purely Canadian phenomenon. And I'll just mention that the range that they use in the United States is very similar, 2.5 to 3.5, and it's not necessarily the case, but there's bound to be a fair bit of correlation between them, given the global developments. So all we know is that as we get closer to it, whatever it is, we'll begin to see signs that we're no longer stimulating demand. And in fact, if we cross into the neutral zone, we may see signs that we're beginning to constrain demand. And so it's finding that balance, approaching it from below. And we realize that it'll be different from the average performance over the data that we have available, precisely because of the stock of debt has risen so much. So there's an increased sensitivity there that one needs to take into account. And it doesn't mean a mechanical change to it. It just means more of a shading of that risk.
Any other questions? Over here.
Hi, thanks for talking to us today, Governor.
Yep.
Just a quick question about the break-even rate, which I think has been declining since the second quarter. We're currently at around 1.7%, I think. In light of that, I just wondered how you sort of rationalized your potential for faster interest rate hikes, even as that market measure for inflation expectation is starting to turn a bit lower.
Yeah, well, it's as I said in the room, we would never hinge our decisions on a single thing, and would have those all on the table. And that observation could be something that causes us to think, we're at the lower end of the distribution that's on the table, but other data points suggest we're at the upper end of our distribution. And so we need to weigh the strength of the evidence in all those cases, and bear in mind that what we're dealing with here is not a snapshot, but more like a movie. So the whole thing is evolving every day. And so there may be very good reasons why one indicator is not quite telling you exactly the same as another. And so that causes you to put less weight on it at that time and more weight on another. So all of those things are live. They're all on the table. And so we take them all into account the best that we can. But that means that ex post, any decision can't necessarily be reconciled to every single data point that you lay out.
Just quickly to follow up on Brexit, do you then anticipate that the pound would weaken significantly in the case of a no-deal Brexit, and the inflation would pick up? Is that a scenario you foresee?
I'm not offering a forecast today at all about what Brexit might look like or how markets might react. I think there's been more than enough said and written about that I don't need to offer my own interpretation.
What about its impact for Canada then? In the case of a no-deal Brexit.
Well, as before, for us, the main implication would be around the performance of the real economy. How there's a presumption that during the adjustment period there would be a slowdown of some sort, of some magnitude. Not going to make a forecast there, but whatever it did, that would figure into our analysis of global output and how it drives Canadian exporting. So there's a direct link to our modeling. But as I said before, when you multiply each of those things by the weights, you get to a fairly small weight, in the end, because UK is an important trading partner, but of course dwarfed by the United States in our analysis.
One more question over here.
So just Also Mark Jones again from Reuters, going back to what you were saying about the kind of the trade war risks and the possibility if it gets resolved, it's going to bring a lot of goodwill to a lot of economies. Have you got a kind of idea of how much it could boost Canada's economy or the global economy?
Well, we haven't really come to grips with how much it may be slowing the Canadian economy. We did a lot of analysis of this during the uncertainty around NAFTA, and we could tell that, in fact, the main channel of influence was through the investment decision. So it wasn't really slowing trade. In fact, what was slowing trade was the companies were finding themselves at capacity and unable to grow their exports further. So normally you would expect them to invest and expand, and it's exactly the stage of the cycle we were at 18 months or 2 years ago. And so we did see some of this, but far less investment than our models predicted. And we would attribute much of that error term to the uncertainty around Brexit, misspoke, the uncertainty around NAFTA, and so there's of course other factors that could go into that companies mention, competitiveness issues that they face, regulation, et cetera. So it's not entirely due to that, but it's suggestive of a magnitude. And then what we're suggesting is that now that NAFTA uncertainty has been resolved, we should see some of that error term go away. So investment should pick up again towards its fundamentals, perhaps not all the way, precisely because the uncertainty about the future of trade is still there, which has got a different source now with the U.S.-China issue, and we still have some tariffs in place from the United States, steel and aluminum, and softwood lumber, which these are still influencing investment decisions in those sectors. So none of this is back to normal. So you need to figure out how much is it different from normal. And I guess if I believed my model perfectly, I'd say, well, we'll go right back to where the model is if everything went back to normal. So trade tensions just simply evaporated. But that would be a pretty bold call. People take time to adjust. And so what we've said is we've got to wait and see how people react to the reduction in uncertainty around NAFTA. We'll see. We know the direction, and we'll watch it unfold through the investment side. It's primarily an investment decision question.
So if you thought of it maybe as a kind of petrol gauge on a car,
yeah,
how much did it go down due to NAFTA, and how much has it come up since? And
so it hasn't come up since at all yet.
No,
it's too early for us to say. How much did it go down? Something on the order of 0.2 percentage points, 0.3 perhaps in GDP space. But it's primarily, as I said, through both investment and exports, because exports were constrained by capacity limits precisely when you should be investing to expand them. So for both reasons, we had less GDP growth than otherwise would. So that just means that around the edges, you've got an upside risk now to the outlook. We've taken some of it in the latest forecast, but left some of it still there as a negative judgment until we actually see how companies respond. The U.S.-China is harder to put your finger on. It's a little less concrete, but it nevertheless is being talked about extensively by the companies that we speak to.
And one final
Last question.
One final question, if I can. You guys are kind of going along a fairly nice pace, but globally, if you think about the way that central banks haven't really raised interest rates that much at all, do you worry from a global perspective that central banks aren't doing enough now in terms of raising interest rates to build some dry powder for the next downturn?
Well, it would seem odd to me to slow down your economy today just so you have more powder to speed it up some other day. I think we're in a stage of the upturn where we would expect to see supply side dynamics more prominent. I mentioned that Canada was just at that stage about a year and a half ago where we would expect to see more investment, expanding aggregate supply, and therefore a longer period of non-inflationary growth. This is what happens at this stage of every business cycle. Okay, as we get close to potential, companies begin to get confident and expand that potential. And we should bear in mind that all economies are operating at a level of output somewhat below where they were on a trend line prior to the crisis. So there's room for us to grow in that space if we generate the investment and the productivity to create that growth. And so at that stage, I think the last thing you want to do is tighten too quickly, or normalize too quickly would be a better term, because it risks choking off that non-inflationary growth, which everyone benefits from. Now, of course, you ask, are central banks waiting too long? Well, I think this is exactly what the thing is supposed to look like. That's why we have inflation targets. And if we normalize too quickly, then inflation would underperform our targets. So our assessment is that we're normalizing at exactly the right pace relative to our inflation targets. But it remains a process of, in real time, monitoring how the economy is responding. And with more investment, coming to the fore as the main engine of growth, there's substantial upside still to the productivity and the capacity in the economy. So that's something we're all looking forward to.
Thank you. We're run out of time, so that's it for the press conference. Thanks for coming.
Thank you.